This is TreppWire Week in Review for week ending January 27th, 2023. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, the Biden administration rolled out a blueprint for renters' Bill of Rights, and in economic data, a mixed picture. Q4 22 GDP slowed less than expected, and durable goods were a surprise beat. But other data point to trouble ahead. U.S. leading economic indicators index sank, and S&P manufacturing and services indices point to contraction. Manus, so far, the economy has shown to be very resilient in the face of headwinds, but many are saying that's not going to continue in Q1.
Certainly, that's the narrative. The narrative is the rest of the year will be bumpy. This is our third spin through earnings since we really saw the spike in inflation in the spring of last year. And what we were expecting in Q3 and Q2 last year were real profit squeezes, real pressure on the wage side, maybe a slowing of the sales side, inventory issues, supply chain issues. And we really skated through both earnings seasons unscathed for the most part. Earnings did not really disappoint in the way that many thought we would in those quarters. I think what we've seen thus far is more of a mixed bag. We're certainly seeing enormous amounts of layoffs, especially in the tech space. And I think, Martha, you'll inventory some of those for us later. But that's a sign that companies are coming under pressure. Some have been more blunt with their assessments. Microsoft, in particular, gave really disappointing guidance going forward. They were not alone. There's other firms that are seeing the economy either slow or they anticipate it slowing more. But on the other hand, there have been surprises to the upside. Subscriber growth in Netflix, bigger than anticipated. We've seen pretty decent bank earnings in many cases, especially among the regionals. And again, even though it's worse than what we saw in Q2 and Q3, there are some hopeful signs out there. But I would say that when you see something like Microsoft or the sheer numbers of layoffs in Seattle and San Francisco and other places, I think we're a little bit closer to the rocks on shore than we were, let's say, in October.
Yeah, I think that's right, man. I have some nuggets here that I'll read through. U.S. GDP grew faster than expected in last quarter of 22, but that's not likely to repeat in Q1 of 23. So last quarter grew faster than expected, but the expectation is still muted going forward. So, not sure how good the expectations are or the predictions, but it seems like consumer spending, which accounts for about 68% of GDP, increased 2% for the period, which was down slightly from the previous period. Housing was pulling down GDP, dropped 1.3 percentage points from the headline GDP number. Martha talked a little bit about on the lead in, the president, basically creating a task force or putting a blueprint out there to start to look at renters' Bill of Rights. So just some major players could be involved in that. It looks like the FHFA. So for those that don't know, that's a federal housing finance agency. He's asked them to examine limits on rent increases, promoting renter protections. The FTC and Consumer Financial Protection Bureau have also been asked to, root out practices that unfairly prevent applicants from accessing or staying in housing. There was actually some legislation, I believe in California this week, that actually renewed or reinstated the eviction moratorium for a lot of the multifamily housing out there. So it's interesting, depending on which side of this equation you fall out on. Obviously, people feel like in some instances, property owners have been too aggressive with pushing rents, creating unfair opportunity for housing for folks that maybe are on the lower end of the income spectrum, pushing them out. On the flip side, we've never really had any type of national rent control, and it's kind of a slippery slope if we start going down that path. And so in certain markets, you can actually see where rent control that have been implemented actually reduces the inventory of available units, which actually drives up rents counterintuitive to what they're trying to solve. So, not a whole lot of color here at this point, other than just to say it seems like this has been considered an initiative that the president's going to make a more concerted effort in going forward. If we look at Housing, I think we got some good news here. Home sales rose 2.3%, 616,000 in December. That was revised up from 602 in the previous month. Mortgage rates fell for the third consecutive week. So average 30-year mortgage rate was 6.13 as of Thursday. That was according to Freddie Mac. Not great news there. I mean, nothing to run home happy about, but maybe some reprieve that we're seeing in the market, some liquidity, some transactions happening, mortgage rates coming down slightly, maybe some small green shoots on the economic front.
Yeah, I think the biggest chill of all last week, on the broader markets, maybe it was the Microsoft earnings or the Intel earnings or something like that. But in the CRE space, it was clearly that, for me, it started with the Wall Street Journal editorial 4 or 5 days ago, which, I had no idea this was a possibility. If you read only one thing in the next couple of days about this particular issue, that's not a bad way to get in front of it. It was posted on January 22nd. In short, it says the White House is considering a series of executive actions. So like a lot of other things we've seen over the last 10 years, this is, and it's not Republican or Democrat, it's both, right, have tried to exercise this executive power to effectively legislate without Congress. This would be an executive action if the White House goes ahead with this, which is essentially looking to put in place a national rent control, to your point, limits on how much increases can be pushed through and so forth per annum and so forth. So I would think that this would really be a disruptor, right? If this got somewhere and was implemented through executive action, I think the first thing that would happen is you'd see lawsuits to try to stop this from happening. But if it was implemented, it would really change the nature of multifamily development nationwide, right? You're changing how the market operates. You're limiting the upside. And accordingly, in my opinion, people may feel differently, but people would take less risk, right? They would be less willing to put a shovel in the ground on spec. They would probably pay less for properties that are out there. And when that tends to happen, when the economy slows down because of governmental control, often 3 things happen. Number one is supply starts to dry up. As supply dries up, prices start to go up. And because profits are limited, developers tend to not pump in as much money to maintain, sustain, redevelop, refurbish properties, right? We have some pretty extensive data on that in New York and other cities over time. I don't like to get political on the podcast. It's not my place, but this is one of those things that if it passed through, it would be a very disruptive step for the commercial real estate markets.
I did notice, and remember back in the day when we were talking about the CDC implementing eviction moratorium, we thought that it was such an odd thing that agency had the authority to do that. Well, there's enough question around the FTC similarly getting involved in banning evictions or rent control or some other things. So I think there's going to be some legal challenges to how far these agencies can stretch their authority in places where, honestly, many of these things are controlled at the local level.
Yeah, I mean, the truth is that sometimes it's not the law that can chill the market, it's the threat of change. And even if this is bandied about for 9 months or a year before an executive action takes place, and then it takes 2 or 3 years to litigate, that's 3 years when multifamily developers are kind of on pins and needles, trying to decide where they should lay their bets, where they should invest, where they should perhaps keep their powder dry and so forth. So it doesn't have to come to something passing for this to have a major impact. It will be very, very interesting to see how this plays out. We've seen some very, very big announcements over the last couple of years, whether it comes by way of student loans or healthcare, right? Expanding healthcare, eviction moratoria. The government has been very, very aggressive in the steps it wants to take to put through its agenda, and not just the Biden administration, several administrations now. And, to date, we have yet to see, I think, a dumpster fire come out of this. But there has been, pockets of pain for landlords with the eviction moratorium and so forth. And I think that could be the case here. Time will tell. It's very hard to say.
This is a pretty simple answer in my estimation. You build more housing. I mean, if you look at the housing shortage that we have across the U.S. at all levels of the spectrum, we have a significant deficit, which creates a supply-demand imbalance, which gives the property owners leverage to increase rates at a pace that's probably unsustainable for a lot of renters. If we built more housing, incentivized developers, as you mentioned, Manus, the flip side of everything you said is also true. The government could actually implement procedures and programs to incentivize development, which would actually increase a number of available units and actually create an equilibrium where rental prices came down. We saw it in the 1980s. Community development organizations built multifamily. That was a decade where we saw more multifamily development than any other. And so I would hope that at some level, people are at least looking at that as a viable option, because the other answer to this could just simply be adding more available quality units for renters to be able to have some competitive opportunity in the marketplace to get affordable places to live that meet a good standard of living. And I think developers are hungry for that if they can make it pencil. And the way you make that pencil is through public-private partnerships and other incentives to get developers inclined to build in your location.
We'd love to hear what you think on the podcast. As Lonnie says, we seem to get 5, 7, 10 reach outs per day. A lot over the weekends we get from listeners with various opinions, always really well thought out and very defensible in terms of the data they show us and other things. Sometimes it's in agreement, sometimes it's in disagreement, but we'd love to hear what you think about this issue. Is it something that will gain traction and will be taken on by the Biden administration? Yes, no. If the answer is yes, and you think it will take root, how impactful will it be? We'd love to hear from you. And, maybe there's some alternative opinions out there that we're not considering, but we'd love to hear, the entire spectrum of what people have in mind when they think of this issue.
So talking about some of the earnings we saw, it tied, not surprisingly, to a number of tech layoff announcements, IBM, SAP, another approximately like 8,000 or so total layoffs. The thing that's concerning is outside the tech space, you saw Dow and 3M also announce reductions in force. So, one of the questions we had asked ourselves probably a few weeks ago was, is this going to be something that we start to see happen in other sectors? And that does seem to be playing out.
I think it will. I think that working from the bottom up for an earnings number, right? You've seen wages go up. You've seen general expenses go up, cost of doing business, supplies, and so forth over the last couple of years. You've seen borrowing costs go up. So the margins are getting squeezed. And I think this is a line I used maybe 3 or 4 months ago. Company CEOs don't take this lying down, right? At the first sign of margins degrading, they try to defend that margin. And that usually comes by way of layoffs. In this particular cycle, it's using less space, getting rid of space, consolidating offices, and so forth. And even if we haven't seen a category 5 yet in terms of economic impact, if they think we could be seeing a category 3 in the spring or summer, right, they are going to be aggressive and forward-looking in sharpening their pencil, right, and trying to defend that margin. And it's just not debatable. It's what companies do. We've seen it from banks, right? Goldman Sachs and Morgan Stanley have done it. You mentioned several big industrial firms this week. The tech space has been decimated with layoffs, and it will continue, I think, right? There's nothing that says to us in the near term that the top line is going to explode because the economy is rebounding quickly, or that wage pressure, interest rate costs, or supply costs are going to plummet, right? So this particular squeeze that companies are in right now is likely to last for most of 2023.
Yeah, I think if you look at consumer spending too, we've seen a lot more headlines around credit cards, being stressed, and, people are not necessarily defaulting on them yet, but they're stretching the limits. They've spent through whatever savings or additional cash reserves they had coming out of COVID. And so I think, to your point, Manus, the cost side for these companies is very real. They're trying their best to manage it, but labor, supply chain, all of those things have been really disrupted. And if the consumer continues to lessen or weaken some of their spending across some of these sectors, I think 2023 is going to be a real challenge for some of these. It seems like, phase one is laying off workers and trying to cut costs that way. Phase two is downsizing or right-sizing the real estate portfolio. Maybe that's enough. Maybe it's not. I guess we'll see how that plays out over the rest of the year for some of these companies.
One of the big ones I saw this week really scared me, Lonnie, just for your sake, when I saw that Microsoft was closing down its metaverse alt space VR. And I don't know what that means. Like, Lonnie, if you're in the metaverse, when they close the door, are you like Samuel L. Jackson at the end of Jumper, where you're out there in like the desert and there's nobody around you for thousands of miles? You're just isolated if you don't get out of the metaverse in the nick of time. I don't know. You're gonna have to tell me and how that works.
Yeah, I don't really know too much about the metaverse. Although if I ever got in the metaverse, I would be like 5 inches taller and a lot thinner and a lot better shape for sure. I think it's didn't Tom Hanks have a movie where he's like trapped in the airport? That's kind of what I would envision. This is like you're trapped in the metaverse and you can hear people talking, but you can't get out. Something like that. I don't know. I'm too scared to jump in there.
I could picture you in the metaverse, Lonnie, being 6'5", being like The Rock, making your pecs go up and down in opposite directions to music.
Oh, boy.
Yeah, I mean, I do that now, but it would just be a little bit more, forceful in the metaverse.
Defined.
Yeah, exactly.
Oh, my goodness. Well, now I got to move on. But I did want to comment that with all of that, yet we see companies like Walmart raising their wages and Chipotle announcing that they're going to hire 15,000 employees.
Yeah, I mean, this whole week, it hasn't been the anvil, falling off the side of the cliff, getting ready to hit Wile E. Coyote, right, and flatten him. There's been plenty of crabgrass out there, from layoffs to weak earnings to disappointing guidance, but it hasn't been, a straight 180-degree, 100-mile-an-hour, body slam, right? There have been green shoots. Walmart certainly is making enough money to raise wages. We've seen Netflix, as I mentioned earlier, beat on the subscriber level. There have been some upbeat earnings surprises. So it's a mixed bag, to be sure, but it does feel like the wind is blowing cooler now than it was for the last two earnings seasons.
And when times are volatile, it is tough to know where you're headed, but we thought we would give a sneak peek at a report that we're going to be putting out about historical loan spreads and how they can provide a good metric during volatile times.
We talked about this down in Miami with a lot of our clients, and this is something we've been kind of sitting on data-wise for a while. And in short, over the last 25 years, through our securitization modeling process, we have collected data on tens of thousands, if not hundreds of thousands, of loan originations. And with every fixed rate loan origination, you get an origination date, a loan rate, and a term. So you can, in theory, back into the loan spread. You could see where people have been quoting spreads on every loan going back in time. Now, there is a caveat to this. Nobody tells you exactly when they lock in a loan rate, whether it's 10 a.m. or 2 p.m. or 4 p.m. So you don't know precisely where the treasury curve is at any given time in a day. And there's certainly rate locks, which can create a little bit of noise for any one individual loan. But when you take this in aggregate, in theory, when you're spreading this calculation over tens of thousands of loans, the positives should outweigh the negatives, meaning the amount of times that you quote a loan through the data that has a couple basis points higher in spread should be offset by one that's a little bit lower in spread, right? Based on the timing in a given day. But the reason we've put this out is when you look at this data in bulk, what you can see is how lenders were quoting loans and making loans during periods of heightened volatility. Our own Alan Drayton, who's a senior guy here, he's been with Trepp quite a while. He's been sifting through the data for quite some time. And when you look at the graphs, and this is a product we'll be putting out very shortly, along with some research with it, you can see how much spreads have gone up during periods like coming out of the Great Financial Crisis, going into the Great Financial Crisis, during the oil bust of 2015 and 2016, in the first 2 or 3 months of COVID, et cetera. So it's a very useful tool to say, in the absence of a lot of lending going on right now, where should I be reasonably quoting new loans compared to where I was quoting them 6 months ago or a year ago. And sometimes the best way to look at that is, let me see what was happening in 2016. Let me see what was happening in 2009, 2010, and use that as a benchmark. And what you'll see is during various times, spreads jumped out 100, 150, 200 basis points above where they had been. And I think that can provide for loan originators a nice sanity check. And for modelers, people that have to do value at risk, mark to market, warehouse lines, and so forth, it's an interesting set of data. So we hope you enjoyed the research and you look into seeing some of our insights in the next couple of weeks.
Yeah, I would just say if anyone's interested in seeing a demo of that or digging a little deeper into how that may be useful within your current workflow, send us an email, podcast@trepp.com, and we'll get you in touch with somebody that can walk you through that on our side.
And this week we did see a CMBS deal price. What does that look like?
Well, when we talk about the week not being a one of complete crabgrass, a new CMBS issuance is certainly a green shoot. We knew Q4 last year was going to be challenging in terms of issuance volume. We knew that both CRE, CLO, and conduit lenders were pulling back. We knew from talking to people in Miami and from reading the press that originations had slowed sharply. So we weren't sure when we'd see the first conduit deal, but we did see one come out to market in the last couple of days and price successfully and get over the finish line. I'll go through some of the levels that we saw. Congratulations to the folks at BMO that got this over the finish line. The deal in total was almost $800 million in size. It's BMO 2023-C4. The spreads going down the credit stack, the short pay AAA classes were 135 basis points over the SOFR swap curve. The medium length 7-year AAA class, 160 over, the A4, the A5, 156 over, and 158 over. So you're talking, let's for argument's sake say 155 over on average for the AAAs. For the AA minus, 250 over. For the single A minus, 425 over. We didn't get pricing for the BBB or BBB minus, but I think it's fair to say that would be somewhere in a probably 600 handle. Somewhere in that, maybe a 650, but that's me kind of spitballing where I think this might have priced. We didn't see any data on that, but that will give people a sense of where the bond markets are today. To give you a sense of perspective, this is sharply better than where we were late last year. Late last year, among the last conduits to price, the long AAA was about 185. The AA was 300, give or take. So this is 50 basis points tighter. The single A minus 475. So not only have we seen an improvement in overall rates with treasury yields coming down over the last 2 to 4 months, maybe 1 to 2 months, let's say, we've also seen spread compression, which when you add the two together makes lending rates for borrowers a little bit more palatable than they were November, December of last year. But I wanted to throw out, if you don't mind, Martha, 3 more metrics just to give people a sense of where lending is happening. The weighted average coupon on those loans, and there were 46 loans in that pool, weighted average coupon 5.9%. So if you're a borrower out there, that could be a benchmark for you for where conduit loans are getting made. Of course, there's a big difference between multifamily and office and hotel, but the weighted average coupon was 5.9. Weighted average LTV, 53. Weighted average debt service coverage ratio, 1.94x, and the percentage that were full IO, this kind of surprised me, Lonnie. I'd love to see your thoughts on this. 72% of the loans, even in this market, still full IO. What do you think of that?
I guess that means they're thinking in the longer term that rates will revert back to, maybe some sort of a lower threshold, and that the market will recover, because in an interest rate only full term, you're effectively banking on the value of the asset to appreciate through market conditions. And given where we're at right now, I mean, what we're seeing is a lot of properties going to be struggling in 23 and 24 to refinance out of those loans because the market has turned. They haven't had any principal pay down. Values have declined, and they still have the full balance of the loan out there. So I think it's interesting. I mean, it makes sense in terms of a debt service coverage ratio. Maybe if rental rates are down or expenses are up, so NOI is getting squeezed, and you can squeak by on an IO DSCR test that's maybe a little bit less restrictive. But yeah, it's interesting. I haven't dug into that. Those are my initial thoughts.
And we normally start with our property sectors. We're going to break out the retail story on Regal Cinemas to talk about that first, and then we're going to pivot to office. But the story of Regal, which is the parent company of Cineworld, as part of its bankruptcy, announced that it's going to close 39 theaters, including one in the DC Chinatown area.
The bankruptcy judge approved the lease cancellation for that property you were talking about in the DC Chinatown area. That theater is slated to close next month. It's another, negative story for the Gallery Place, which, has seen a lot of tenants move out. So we have, a couple of stories here. There's Bed Bath & Beyond that looks like they shut down in 2020. Lucky Strike, which was a bowling alley, that also shuttered in May of 2020. Washington Sports Club, Urban Outfitters. There was a lot of tenants there that, at the onset of the pandemic did not come out on the other side. And now you add the Regal Cinemas closing down that theater there as well. It's interesting. I think, some of the anecdotal commentary around this was it wasn't so much that it's, property specific or that there's something with this particular location from a retailer or from a real estate perspective that was driving these mass store closures. There was actually some comments that the biggest challenge they have right now is crime. And I think we've talked a little bit about some of this in San Francisco with some of the retailers there boarding up stores or taking inventory out or having difficulty operating, at a profit in those markets. And so, this is the first time in DC that I think we've seen these type of headlines. I think this is an interesting case study. It'll be interesting to see what happens from here. If you're the owner of this property and you've lost several of your marquee tenants, and their external obsolescence, factors like safety and crime and other things that prevent you from re-tenanting that location, it's going to be really interesting to see what happens to the viability of this asset, in the medium and longer term.
Yeah, for those that don't know, we really work hard here at Trepp to try to, anytime we see these store closings, whether it's a onesie, twosie, Macy's type situation or Dillard's, or whether it's a bankruptcy where the number of store closings is in the dozens, we always try to tie these back to the CMBS assets that are impacted. So with the Bed Bath & Beyond, I think they're up to about 125 closings at this point through two major announcements. We've been keeping people attuned to which ones we know to be closing and how much debt they have on them. We also keep track of all of the Bed Bath & Beyond intersection with CMBS, even if it's not an announced closing, so that people can get ahead of the issue should they want to know where their risks lie, should that 125 grow to 250. We've done the same thing with Party City and others. So it is one of these things that we really try to keep in touch with. But that reminds me, I'll pivot to a very quick green shoot that I failed to mention last week. The CEO of Macy's last week put out a statement which said, we're pretty much at the end of our store closing efforts. I think over the last month or two, they announced something 4, 6, 8, something like that, a relatively small number of stores that they were closing. JCPenney was the same, like a onesie, twosie type thing. But I think that's a good sign for the department store space that the pruning that has gone on in those spaces has really, really slowed down considerably. There was a time where you get past the holiday season and you'd expect the announcement from Macy's that they were closing 60 stores, right? They wanted one last holiday season. And once they got by there, the announcement would come out. And it was very encouraging. Like I said, we saw, I think, 2 JCPenney's and 4 or 6 Macy's. It was a very positive trend.
Yeah, I think if I take this back real quick to what Martha had mentioned earlier with Chipotle, just another good retail story. As part of that hiring blitz that they're going to do to get 15,000 new employees, it's because they want to double their footprint from about 3,100 restaurants to 7,000. And you mentioned the holiday season, Manus. Chipotle actually has what they call burrito season. So I don't know if you knew that, but that's March through May is the Chipotle burrito season.
There we go.
And pivoting to office, we had Brian B., I'm going to give him an early shout out, who pointed out that the latest Castle Systems data for in-office occupancy the week of January 18th is hovering around 50% for the 10 cities that it monitors. So It's surprising in some cities that it's not gotten above, say, 45%, and others that are hovering above 50. Not surprisingly, in Texas, Lonnie.
Yeah, so it's interesting. Like, it's been probably 2 or 3 months since we mentioned the Castle system reporting. So I think we maybe take for granted and assume that more people are back than what they really are. I know we've at Trepp been on the 3-day in-office work week for a while, and had really good success with that across our company. But to your point, Martha, I mean, the average was 49.5%. Austin led the way at 65.1%, Houston at 60.9%, Dallas at 54.3%. So no surprise there. Texas has been open and back in business for some time. But one that jumped out at me as kind of interesting is Chicago was there at 50.7%. So we've talked, at length about some of the struggles with the office market in Chicago, but it seems like pretty strong representation there from this Castle Systems update. Washington, D.C., San Francisco, Philly, and San Jose round out the bottom of these on the major markets. So D.C. was at 45%, San Francisco at 43%, which is actually probably higher than I would have guessed if I had to pick a number. Philly at 42%, and San Jose sub 40 at 38.2%. So still not great news, if you look at it holistically, but maybe some green shoots there for Texas, and I think Chicago for sure.
Yeah, I think the good news out of these numbers is, if you're looking for positive signs, it seems like they're up between 5 and 10 percentage points over the last 2 or 3 months in aggregate. And it seems like even at the bottom end, what was 33 at one time is now 38 or 39 or something like that. Things are creeping back across the board, which is encouraging. I don't think the shape of the curve has changed at all. I think the winners have been the winners the entire last 18 months, right? Texas and other Sunbelt cities. And the losers have been upper Midwest, Northeast, and California. And I think that will continue. What we can hope for is that, we see another 5 percentage point bump across the way in the next 2 months. And that continues to be something that inches up month after month. Let's hope so.
And in another separate poll, interestingly, 44% said they would take a pay cut for their ability to work at home.
It's, I don't know what to make of that, really. I mean, you've had 2 years where you didn't have to take a pay cut to work at home, right? It was just part of the nature of the beast. Are we getting to a point now where these people who really want to stay home are getting so squeezed that they're saying, okay, I'll take a pay cut. Please just don't make me come into the office. Like, is that a sign of desperation?
Last ditch?
Or is this kind of just, a theoretical poll, which, what would you do for a Klondike bar type thing, which, yeah, sure, I'll take a pay cut if I could stay at home. It's hard to know what to read into that.
Would you rather?
Yeah, I think it means that they would have to quit one of their other jobs that they're working, with the work from home, and they have 3 jobs. So they're willing to take a pay cut on one of them so the other 2 don't find out they've been working with someone else as well. So they don't quantify how big of a pay cut either, Martha. So
no, they don't.
I think that'd be an interesting component.
So we've got a number of office stories that we'll need to run through quickly.
This one it was funny. This one I noticed about 5 minutes after we got off our last podcast. We talked about how much bad news there was in Seattle with Microsoft giving back now an aggregate of 1.7 million square feet, Amazon pulling the plug on a new development out there. Right after last Thursday's cutoff, we saw an article from Alex Halverson of the Puget Sound Business Journal that Amazon, not only are they going to not follow through on the office that they're going to build in downtown Seattle, they are now going to give back about 400,000 square feet at a tower on West 8th Street in Seattle. Amazon has been there since 2011. The building is at 2001 8th Avenue. The interesting thing there is Kilroy acquired this particular asset in the fall of last year, if I'm not mistaken, for almost $500 million. So probably at the time that Kilroy was making this investment, they probably thought there's no way Amazon is not re-upping for this thing. And now, not even 6 months later, the news has changed dramatically. And even worse, Kilroy will have to try to re-tenant this thing at a time where there's just oodles and oodles of space in Seattle. Other crabgrass, this is from Greg Cornfield of Commercial Observer, a really eye-catching headline. And office investors want out of downtown Los Angeles. His example there is the Pac Mutual building, which is owned by Ivanhoe Cambridge. That firm has put the building out for sale for $100 million. That is a 50% discount over what they paid for the property in 2015. The Canadian firm paid $200 million for that asset in, just 8 years ago. In the article, they also note that the Aon Center is also up for sale, and there the owners are looking to sell it for about $50 million less than what they paid for it in 2014. We do have some green shoots out there. This is from Gabriel Frank of the Commercial Search News website. Ares Management has signed on to become the new anchor at Anderson Towers. That is a 900,000 square foot development going up in Century City in LA. Ares has signed on for 12 years and a little over 200,000 square feet. They will also get naming rights to that building. Ares is expected to take possession in about 15 months, June of 2024. Also in California, we have a lot of crabgrass in California frequently, but here's a second piece of green shoot out of California this week. From Pasadena Now, Western Asset Management has renewed its lease for 185,000 square feet in Pasadena. They are at Western Asset Plaza, which is on Colorado Boulevard and Los Robles Avenue. So a couple of green shoots there. Lastly, a mixed green in St. Louis. I'd say it's more green than crab, but I'll let you guys be the judge. This from Gloria Lloyd, a frequent pop-up in our weekly podcast. Equifax will be taking 71,000 square feet at Centene Plaza in Clayton. In St. Louis, any lease is a good lease. We've seen that city get decimated by companies closing up shop and pulling out. The fact that they are signing on for 71,000 square feet is a great thing. The crabgrassy part of it is that they currently have 2 offices in the area totaling about 195,000 square feet. And it appears that those offices, one in Earth City and one in Maryland Heights, will both go vacant. But that new tower, that Centene Plaza, has been attracting tenants right and left. It's at 7676 Forsyth. And not only do they have Equifax, they also got Pulcinelli. So a heartbeat in St. Louis in 2023.
Yeah, I'd love to know on that building in particular, like what some of those rental rate terms are. I mean, we've seen St. Louis be so decimated over the last several years. You mentioned this building has seen some traction. Are they getting those tenants in with, very favorable rental terms, TIs, et cetera, or are those tenants moving there because maybe the building is just the best option from a utility perspective? But if you have any of that information I'd like to share with us, I'd like to just get a feel for what that looks like, because that market has been really downtrodden for some time.
I don't know the St. Louis market very well at all, other than what I see in the data, but it does seem like the stock there is quite old. And I think, this might be a case where you put up something new and shiny, and people are so thirsting for something new and shiny that they can really attract anybody that's on lease expiration at a pretty decent price. Let's hope it's, it becomes an anchor for other places around them, that becomes kind of a magnet for other developers to start putting up places, and St. Louis starts to see a renaissance.
So we have a big Boston deal that we'll cover here, the Waltham Life Science Complex. We've talked a little bit about life science over the last couple of months, and it seems like that market is still, working very well relative to some other asset classes. So that complex sold for about $600 million. That's according to the Boston Business Journal and BizNow. Alloy, which is an affiliate of the PE firm TPG, sold the campus in Waltham for $578 million. It was a large property transaction, so one of the largest ones in the greater Boston area. About 600,000 square foot complex, was acquired by a California-based company, Capital Management, or CS Capital Management, Inc. Once a research and manufacturing hub for Raytheon. Current tenants are Repligen, Affinia Therapeutics, and Abcam. Alloy had acquired the property in 2020. Looked like in a couple of transactions, which are about $330 million in total. The complex is located at Waltham Watertown Line, spread across 3 different property addresses. Alloy focuses on life science properties, and they really like the markets that you would expect: Boston, San Diego, and Seattle for these asset types. So we're going to round out our office overview here with one more green shoe. This comes from Danny Eckert at Cranes. There's an acquisition of a Baxter office campus. So this is a Chicago industrial developer. Is reportedly close to a deal to buy the Baxter industrial headquarters campus. This is in Deerfield. The idea here, though, is that they would have a plan in place to redevelop the property with warehouses and effectively convert this into industrial space. So the property itself is comprised of about 10 buildings, 646,000 square foot. Sits between Saunders Road and Interstate 294, north of Lake Cook Road. It's been underway for some time. It looks like negotiations are taking place over about an 8-month period. JLL was hired to market the property. The firm reduced its office footprint. More employees work from home. So highlights of this transaction, it really identifies this industrial market as having some real strength. So again, we've talked a lot about office to residential conversions. This is maybe the first office to industrial or office to flex type of conversion in that marketplace. And some of those underlying fundamentals, local industrial vacancy rate fell to a new record low, about 4.5% in the second quarter, which was down from about 6% a year earlier. And that's according to a Colliers report. So, we've talked about how viable office to residential conversions are. Maybe it makes sense in some of these where there is a slight flex or industrial play. The renovation cost relative to a residential place would be a lot less than an industrial reposition. So, this may be a trend that we see some more activity on, maybe in some of these suburban locations where some of the building codes and zoning allow for it.
And turning to retail, we'll do a couple of stories to finish out our property sector stories.
Yeah, this is a couple of stories that came from our TreppWire franchise. That segment of the market, the shopping center segment, that includes places like Burlington and Marshall's, Best Buy, Petco, Big Lots, etc., continues to just be so strong. We had an alert this week about a property in Houston that was valued at $31 million in 2013. The value was cut by a third last year. The property lost Best Buy and Big Lots as tenants. DSCR tumbled to 0.6 in 2022. Just when you think that maybe this market is starting to crack, the owners there lure in a Burlington, and now they're getting ready to defease that particular asset. So it just goes to show really how resilient that market is. On the negative side, we reported that the shops at Wiregrass in Florida, this is a $72 million loan backed by a mall in Wesley Chapel, Florida, that went delinquent for the first time. So while the shopping center space has done very well, the mall space continues to just limp along. That's the first time the property has gone delinquent, that shops at Wiregrass property. And in Texas, the $65 million Arbor Walk and Palms Crossing loan has been extended a second time, which underscores the third narrative at retail, which is even when you think that a mall has reached the end of its life, they tend to find new life via extensions, modifications, rate cuts, bifurcations, and so forth. And that leads us to a question which one of our listeners had. Martha, you had it. You could tell us maybe who brought this one in, but it's how quickly do things resolve? And the answer is, I would say the lion's share of these things take years. I think in most cases, a contested asset where the borrower tries to negotiate a forbearance or a modification, makes the special servicer go through a judicial foreclosure, and a sheriff sale. I think 18 months would be kind of the short end of that period, but we've certainly seen things like that linger for 2 years, 2.5 years, 3 years. It doesn't happen very quickly, even more so if the property is cash flow positive for its interest. These things take a really long time. The two exceptions would be if it's a stipulated foreclosure or consensual foreclosure. Those could happen a little bit more quickly. Sometimes you see those happen in a couple months, but even then, the property can linger in REO for months and months and months. The fastest way is a note sale where the special servicer just says, I want to make this somebody else's problem, and they sell the note. Sometimes that can happen within 6 months of the first sign of trouble. Hope that answered your question. If it didn't, by all means, reach out to us by email again. And Martha, do you have that name so I can give?
Yeah, that came from Brendan H. So about how long CMBS deals take to work out when they're in special servicing?
It can take, I mean, there are still assets that were originated in 2007, not many, about $5 billion left, that just remain unresolved at this point, right, on their third extension and so forth. But Brendan, thank you for listening and thanks for your question, and looking forward to hearing from you again.
Okay, a couple programming notes. Our Market Pulse webinar is tomorrow, Friday, January 27th at 1. If you don't have the details, contact us at podcast@trepp.com to find out how to log into the registration for that. Should be good. Lonnie and Stephen Bushbaum, our research director, will be talking about some of the macroeconomic news and analyzing data and trends that may impact the market. So you should tune into that. And we're also hosting a benchmarking webinar on February 7th at 11 a.m. with our own Matt Anderson, Lucius Clay, and Ben-Ching Chen. They're going to provide a deep dive into some of the lending market information and trends there. So if you're interested in that one, also give us a shout. And some of the shout outs, we have a bunch that were on LinkedIn. Charles D shared his new TreppWire podcast gear, and he took a picture and put it out there, and we got some interesting comments on that. Aaron B, Michael D, and we want to give a shout out to Michael B and the crew at America's Commercial Real Estate Show, where Lonnie had the opportunity to sit in on their podcast, talking about some of the data that we've seen.
We had a really great time jumping on Michael B's podcast, talked about loan distress and delinquency in the marketplace and kind of where the data is telling us the market is heading into 2023 and 2024. So if you enjoy this podcast, you should check that out as well. I think you'll find the data that we provided from Trepp as very insightful relative to where the market is today.
It wouldn't surprise me. I mean, Lonnie, he's on the East Coast, the West Coast. He's down in Miami making presentations. You know, there's not a day that goes by where I don't see an image of Lonnie somewhere. He's like, you know, the St. John the Baptist of commercial real estate. He's out there evangelizing and teaching and bringing in new converts. There's a part of me that says in 2024, when they come out with that list of the most popular names, Lonnie's going to be on the top 10. It's going to be, you know, Liam and Ethan and Jacob and then Lonnie. That's my prediction for next year.
That would be really interesting. And as we found out, it's not short for anything.
Yeah, that's it. It's just Lonnie. There's no, it's not a nickname. That's the name.
That's interesting. And a few more shout outs. Robert J., who's a listener from the UK, reached out to the team and said he found the information very insightful. And he says he's found that the US is usually 6 to 9 months ahead. However, in some instances, we're dual tracking. So we'll have to see if that holds up. And Arrest, who was on our pod last week, gave a shout out to his sons and their friends who tuned into episode 177, which I think, Haley, may account for the spike in listenership that we had for that week.
Well, we got to jump in there with Arrest. 2 of his boys are in the military defending our country. And every opportunity I get to reach out and thank our servicemen and women for their sacrifices, it's a good diversion. So thank you, gents, for listening, and thanks for serving your country.
And Ben P on Twitter, if you're too old for TikTok, this podcast is for you. I can't think of a better tagline. Silas on Twitter, what this person finds really interesting about the podcast is that they don't have a political bent. So I hope we held to that today when we were talking about some of the policy discussions. Roy on Twitter, this podcast is the best thing out there. So thank you for saying that. Alex H. from Puget Sound Biz Journal thanked us on Twitter for mentioning him and his story. Hemant C. on Twitter, Martha and the Trepp team, thanks so much for putting out great content each week. And separately, he's teaching a real estate capital markets class at UT Austin, and our content has been very helpful in creating class material. So happy to help. And if you ever need more, feel free to reach out to us. We've got a bunch of ideas of how we can add to that.
Yeah, and I actually owe him an email. We're gonna grab lunch down in Austin. So email will be incoming. So we'll circle up on that.
So, we talked about remote work, and we've talked about these stats every now and then. U.S. workers have saved an average about 55 minutes a day now that they work from home or hybrid. But we got nothing on China. China workers apparently have saved 102 minutes on average. So I don't know how they were getting to work, but that was a long ride.
Well, I have I have a fairly long commute into the office, but it's luckily only 3 days a week. But every month when that toll tag bill comes, it's about $600 a month. That's not great. So, I'll happily take 55 minutes over 102. I'm with you, Martha. I'm not sure. I don't know how that works. 102 minutes a day commute. So maybe that's some of the survey participants that said they'd be willing to take a pay cut. Maybe it's starting to make sense for me now.
And with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what happened during the week and how it may be impacting you. If you have a question or comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.